Most people think surviving an economic crash is about luck, getting out at the right time, happening to be in cash when everything falls apart. Pure chance. They're completely wrong. The investors who not only survive but build generational wealth during crashes do something everyone else refuses to do. They prepare while the party is still going. They act on signals that seem paranoid until they're proven right. And they execute strategies that feel insane until those strategies make them wealthy beyond anything possible during normal times. The 2026 crash window is approaching with mathematical precision. Every historical indicator that matters is flashing red right now. The yield curve that's never been wrong, the debt levels that always precede collapse, the insider behavior that signals trouble before it's visible, the commercial real estate time bomb that's already ticking. These aren't opinions. They are patterns that have repeated throughout financial history with brutal consistency. But here's what separates this moment from every other market correction. You have time. Not much time, but enough. Enough to position yourself on the right side of the greatest wealth transfers most of us will ever witness. Enough to build the foundation that turns crisis into opportunity. What I'm about to show you isn't theory. It's the exact playbook used by investors who profited massively from 1929, 2000, and 2008, while everyone else was destroyed. The difference between financial ruin and generational wealth comes down to specific actions taken in specific sequence before the chaos arrives. Let's start with the foundation that makes everything else possible. Cash positioning. And I don't mean keeping a little extra in your checking account. I mean deliberate, substantial, uncomfortable levels of liquidity that everyone around you will tell you is stupid. This is the single most important preparation step, and the one most people completely botch because it requires fighting every instinct and ignoring all social pressure. Here is the framework. You need 25 to 40% of your investable assets in cash or cash equivalents before the crash window opens. Not after you see stocks falling, not when the news starts looking scary. Right now, while markets are still near highs and everyone thinks you are being ridiculous, the specific percentage depends on your situation, but the principle is absolute. You must have buying power when assets go on sale. Think about buying power in concrete terms. If you have $500,000 in investable assets, 40% means $200,000 in cash. When quality stocks drop 60%, that $200,000 buys over $500,000 in assets that used to cost $800,000. When they recover to normal levels, you have more than doubled your money. But you only get that opportunity if you built the cash position before the crash, not during it. The psychological battle here is intense. Your portfolio will underperform while stocks keep climbing. Your friends will show you their gains and question your strategy. Financial advisors will tell you you are making a mistake. Every piece of financial media will celebrate new market highs and declare permanent prosperity. This is exactly what creates the opportunity. The discomfort you feel sitting in cash while everyone else seems to be winning is the price of admission to generational wealth. Where do you hold this cash? Not all in one place. Spread it across multiple institutions to stay under FDIC insurance limits. Use a combination of high-yield savings accounts, money market funds, and short-term treasury bills. The goal is not maximizing return on cash. The goal is preserving capital and maintaining immediate access when buying opportunities appear. You need to be able to move quickly when assets crater. Start building this position now. If you are currently 90% invested, do not try to get to 40% cash in 1 week. Use a systematic approach. Sell 5 to 10% per month over the next 4 to 6 months. This averages your exit and prevents the regret of selling everything right before another leg up. But commit to the timeline. Do not let market momentum seduce you into staying fully invested. The second critical preparation step is debt elimination, and this might be the most important decision you make in the next 6 months. Debt transforms market downturns from manageable events into life-destroying catastrophes. Leveraged investors who looked brilliant during the boom become forced sellers during the bust. They have to liquidate at exactly the wrong time to meet obligations or margin calls. You cannot let this happen to you. Consumer debt goes first. Credit cards, auto loans, personal loans. These need to be eliminated completely if possible. Every dollar of high-interest debt you are carrying is a dollar bleeding from your financial foundation. It is also a dollar of monthly obligation that restricts your flexibility when you need it most. Pay these down aggressively, even if it means delaying other financial goals. Nothing matters more than entering the crash window debt-free. Auto loans deserve special attention. If you are paying $700 or $800 a month on a car loan with 5 or 6 years remaining, you are in a dangerous position. That payment does not stop during crashes. It continues regardless of what happens to your income or net worth. Consider whether you really need that particular vehicle or whether a less expensive paid-off option gives you the flexibility that might save you when the economy collapses. Investment property debt requires harder analysis. Real estate purchased with leverage can be incredibly profitable during good times. During crashes, it becomes an anchor that drowns you. Ask yourself these specific questions. Can I service this mortgage if rental income drops 30%? What happens if I cannot find tenants for 6 months? If property values fall 40%, do I still have equity or am I underwater? If the honest answers make you uncomfortable, selling now before the market turns might be the smartest move you will ever make. Yes, you will pay capital gains taxes. Yes, you might miss out on another year of appreciation. But preserving capital and eliminating obligation beats holding an underwater property through a multi-year recession. Many investors in 2008 lost everything because they could not let go soon enough. Primary residence mortgages are different. If you have a fixed-rate mortgage at a reasonable rate and can comfortably afford the payments, even if your income drops, staying put makes sense. The key word is comfortably. If you are stretching to make payments now, you are in trouble when things get worse. But if your housing cost is manageable and your job is relatively secure, your home is not the debt you need to worry about. The principle underlying all of this is flexibility. Debt removes options. It forces you to take actions you would not otherwise take. During crashes, flexibility and optionality are more valuable than any other assets. The investor with cash and no debt can wait. They can be patient. They can buy when others are forced to sell. The investor with leverage and obligations becomes a victim of timing and circumstances beyond their control. Now we move to the strategy that actually builds wealth during crashes: strategic buying through the decline. This is where preparation meets execution, and most people completely fail despite having done everything else right. They build cash. They eliminate debt. Then they either panic and do nothing, or they blow all their capital trying to catch the falling knife too early. The systematic approach that actually works is tranching. Divide your cash reserves into 4 or 5 separate deployment buckets. Establish specific price targets for each bucket before the crash begins. Then execute mechanically as those targets get hit, regardless of how you feel in the moment. This removes emotion from the equation and ensures you are buying throughout the decline without trying to time the exact bottom. Here is a concrete example. Say you have built a $200,000 cash position. Divide it into 4 tranches of $50,000 each. The first tranche deploys when the S&P 500 falls 20% from its peak. The second tranche deploys when the index is 35% down. The third tranche deploys when it is 50% down. The fourth tranche deploys when it is 65% down. You are not trying to guess the bottom. You are systematically averaging into lower prices. The beauty of this approach is mathematical. If the market peaks at 5,000 and you buy tranches at 4,000, 3,250, 2,500, and 1,750, Your average purchase price is $2,875. When the market recovers to even $4,000, you have made almost 40%. If it returns to $5,000, you have nearly doubled your money. What should you actually buy? This matters more than timing. Quality becomes everything during crashes. You want companies with 3 specific characteristics. First, strong balance sheets with minimal debt. Second, consistent earnings through economic cycles. Third, products or services that remain essential regardless of conditions. These businesses not only survive crashes, they emerge stronger because weaker competitors get eliminated. Avoid anything speculative. No unprofitable tech companies trading on future promises. No highly leveraged businesses. No industries facing structural decline. Stick to boring, profitable, essential businesses that will still exist in 10 years. Think consumer staples, healthcare, utilities, and select financial companies with fortress balance sheets. The goal is not finding the next Tesla. It is buying durable assets at depression prices. Create your shopping list now. Identify 10 to 20 companies you would want to own at the right price. Research their balance sheets, earnings history, competitive advantages, and historical valuation ranges. Determine what price would represent compelling value for each. Write this down. When the crash arrives, you will not have time or mental clarity for analysis. You need to know exactly what you are buying and at what prices. Real estate opportunities will be massive, but they require even more selectivity than stocks. The principle is identical. Quality and location matter more than anything else. Prime properties in desirable areas may lose value temporarily, but they retain their fundamental utility and scarcity. Speculative developments in marginal locations often become worthless and never recover. Focus on properties with characteristics that transcend economic cycles, such as strong school districts, access to employment centers, and desirable neighborhoods with limited supply. These might fall 30 to 50% during the crash, but they will recover because the underlying demand is real and sustained. Buying a beach house in Florida at 50 cents on the dollar gives you an asset that will always have value. Buying a condo in an oversupplied tertiary market might give you an asset that never recovers. The timing for real estate purchases differs from stocks. Real estate markets move slower. The bottom typically comes 6 to 12 months after the stock market bottom. Do not rush. Wait for clear capitulation. Wait for prices to stop falling and stabilize. Be patient. The extra patience ensures you are not catching a falling knife that keeps falling for another year. Now we need to talk about precious metals, because this is where a lot of people make mistakes. Gold and silver are not speculation vehicles for generating massive returns. They are insurance policies against the complete breakdown of paper-based wealth. When currencies lose credibility and financial systems fracture, precious metals preserve purchasing power. That is their function. The appropriate allocation is modest. 10 to 15% of total assets in physical gold and silver, or in precious metals exchange-traded funds. Not 50%, not 0. Aim for somewhere in the middle, where the allocation provides protection without dominating your portfolio. The goal is not getting rich from gold. The goal is ensuring a portion of your wealth survives if everything else fails. Buy physical metals you can hold if possible, gold and silver coins or bars stored securely. This is not paranoia. It is recognition that during severe crises, paper claims on metals might not be honored. Having actual physical possession eliminates counterparty risk. If you cannot store physical metals securely, use exchange-traded funds that hold physical metal, not paper derivatives. The psychological preparation for crash investing might be more important than the financial preparation. Everything in your environment will push you to do the exact opposite of what works. During the build-up phase right now, When you should be raising cash and preparing for trouble, everyone will be celebrating gains and questioning your caution. Social pressure to stay fully invested will be intense. Then when the crash arrives, every instinct will scream at you to preserve whatever capital you have and wait for certainty. Financial media will predict permanent depression. Your friends will be panicking. The news will be uniformly terrible. This is exactly when you need to be buying aggressively. The fortunes are made when everyone else has capitulated and given up hope. Developing the discipline to act contrary to emotion requires practice before the crisis. Study previous crashes in detail. Read first-hand accounts from people who lived through the Great Depression, the dot-com crash, and 2008. Understand what it felt like to invest when everything seemed hopeless. Internalize the truth that maximum opportunity arrives at maximum pessimism. Create a written investment plan. Now that specifies exactly what you'll do at each stage of the crash. What percentage of cash you'll deploy at what market levels. What specific investments you'll make. What signals will trigger action. Then, commit to following that plan regardless of how you feel when the moment arrives. Your future self, panicking in the middle of the crisis, needs current you to make these decisions rationally. The compound mathematics of crisis investing create outcomes that seem impossible. Assets purchased at 50% discounts that recover provide 100% returns. Assets purchased at 70% discounts provide over 300% returns. But the real wealth multiplication comes from the recovery phase. Investors who doubled their money, buying during 2008 and 2009, then used those gains to buy more assets during the following bull market. The combination of crisis buying and recovery compounding creates generational wealth. Let's talk about specific timing, based on current indicators. The yield curve uninverted in September 2024. Recessions typically begin 6 to 18 months later, which puts us in a danger window from March 2025 to March 2026. We are in that window now. Commercial real estate refinancing peaks in the first and second quarters of 2026. Consumer debt metrics suggest stress building through late 2025. Corporate earnings pressures are mounting. The convergence points to late 2025 through mid-2026. This does not mean the crash will start on a specific date. It means conditions are converging, and any trigger could start the cascade. A major corporate bankruptcy, a regional bank failure, a geopolitical shock. The specific catalyst matters less than the fact that the system is fragile, and any shock could begin the unraveling. Your preparation. Timeline should be complete by summer 2025 at the latest. The early stage will not look like a crash. It will look like a correction. Markets drop 10 to 15%. Experts call it healthy, and they point to strong fundamentals. This is the denial phase. Underneath, stress is building. Margin calls hit leveraged investors. Corporate bankruptcies start appearing. Credit spreads widen. These early signals tell you the cascade is starting, even if mainstream narratives have not acknowledged it. The contagion phase is when reality becomes undeniable. What started as isolated problems spreads. If a major bank fails, depositors at other banks panic. Fear becomes self-fulfilling. Credit markets freeze. This is when real damage occurs. Markets that fell 15% during the correction phase can drop another 30 to 40%. Within 3 to 6 months of the initial crack, the full crisis becomes visible. Government intervention follows. Interest rates get cut. Money gets printed. Bailout programs get announced. Markets stabilize temporarily. This creates the most dangerous trap. Unprepared investors see the rally, believe the worst is over, and buy back in right before the secondary collapse. Do not be that investor. Understand that intervention does not solve the underlying problems. It delays them. The secondary collapse happens when people realize intervention failed. Markets that rallied on stimulus hopes fall again, faster and further. This phase typically arrives 6 to 12 months after the initial crisis, and it represents the real bottom. Maximum pessimism meets maximum opportunity. This is when you want to be deploying your final tranches of capital. Your action plan for the next 12 months needs to be specific and written down. If you are not already at your target cash level, begin systematic selling now. Sell 5 to 10% of your stock holdings each month until you reach your target. Use the proceeds to build cash reserves across multiple institutions. If you are carrying consumer debt, make aggressive payments your top priority. Build your shopping list this month. Identify the specific investments you want to own at crash prices. Research their fundamentals and determine your buy prices. Write it all down. Create your tranching plan and decide what percentage of your cash deploys at each market level. Make these decisions now, not during the panic. Evaluate your real estate situation honestly. Investment properties with tight margins need careful analysis. Can you weather significant income drops and value declines? If that prospect makes you uncomfortable, selling before the market turns may save you. Your primary residence is probably fine if you can comfortably afford payments even with income disruption. Consider your precious metals allocation. 10 to 15% in physical gold and silver, or metal-backed ETFs, provides insurance without dominating your portfolio. Make these purchases now while prices are reasonable and availability is not constrained. During full panic, premiums on physical metals often spike dramatically. The opportunities that appear during crashes are brief. When panic peaks, assets trade at irrational prices for narrow windows, often days or weeks rather than months. Having your research complete, your cash ready, and your discipline intact allows you to act while others are paralyzed. This is what separates generational wealth creation from devastating losses. International diversification deserves mention, but it adds complexity. Having exposure to markets and currencies outside your home country provides protection and opportunity. However, this requires understanding foreign tax implications and political stability. For most investors, focusing on domestic opportunities is sufficient. Do not overcomplicate your strategy by trying to predict which countries will perform best. The aftermath will reshape everything. Companies that survive will have less competition. Real estate purchased at distressed prices will generate returns for decades. Investors who position correctly won't just recover. They'll thrive in ways impossible before the reset, but only if they prepared while there was still time. Most people will do nothing. They'll hope it doesn't happen. They'll convince themselves the warnings are wrong. They'll stay fully invested until it's too late. Then they'll panic and sell at the bottom, locking in devastating losses. You cannot be most people. You cannot hope your way through what's coming. The choice is binary. Either you act on the warning signs while there's time to prepare, or you don't. Either you build cash reserves and eliminate debt and create your plan now, or you remain vulnerable. Either you develop the discipline to buy when everyone else is selling, or you watch the opportunity pass while you're frozen by fear. The mathematics are clear. The timing is precise. The pattern has repeated throughout financial history. Those who understand it and prepare accordingly end up wealthy. Those who ignore it watch everything evaporate. The crash isn't coming to destroy your future. It's coming to create it, but only if you're positioned correctly. The window for preparation is closing. Every month you delay is opportunity lost. Every dollar of debt not eliminated is flexibility sacrificed. Every percentage point kept invested instead of moved to cash is buying power you won't have when you need it. The time to act is right now, before the crowd realizes what's happening. By the time the crash becomes obvious to everyone, it will be too late to position yourself properly. The cash you should have raised will be locked in declining assets. The debt you should have eliminated will become an anchor. The investments you should have researched will need to be evaluated in panic conditions. Don't let that be your story. The investors who profit massively from crashes make their decisions before anyone else sees the problem. They accept looking wrong for months or even years. They withstand the social pressure and the psychological discomfort, and when the moment arrives, they execute with precision while everyone else is paralyzed. That's the playbook. That's the difference between building generational wealth and watching your savings evaporate. The crash is coming with mathematical certainty. The warning signs are everywhere. The only question is whether you'll be ready when it arrives.